everyone. I'm David Darst, here to give you a recap of the month of April. It was quite an interesting month. After January, for the S&P 500 being up 1.6%, February up 5.2%, March up 3.1%, April basically showed signs of stalling. At one point in the month, April was down 5.5%, which is probably to be expected after that huge rise of over 24% from the October lows through the end of March. Hovering around 5,100 or slightly up or below. The 2-year Treasury and the 10-year Treasury both experienced significant increases in yields during the month of April. 38 basis points or so for the 2-year, closing at 4.97%, very close to that 5% mark for 2-year Treasuries. That means up 74 basis points thus far this year. The 10-year Treasury, which of course reflects thoughts about the inflation outlook and the economy, up 42 basis points as well, up 74 basis points year to date to close at 4.62%. What are some of the reasons for this? You had the economic results during the month of April were quite strong for the first quarter. You've had the resilience, the job numbers for March, for example, 303,000 jobs. You had retail sales up 0.7%. At the same time, you had inflation flatlining. That means it was not going down. It was basically stalling. Core consumer price index for the month of March, which was reported in April, as you know, 3.5% versus 3.2% for February. Core, that's the consumer price index. Producer price index, 2.3% versus 2.7%. The personal consumption expenditures index, 2.8%, 2.8%. So not going down. That's the Fed's preferred measure, as you know. Gold was up 5.3% in the month. That's after 8% gain in the month of March. And oil was up 0.8% after being up 6% in the month of March. So you had this, it was an economic strength, which basically said, okay, the Fed's not going to be able to lower interest rates. You had Federal Reserve rhetoric, including Chair Powell and other Fed governors and regional bank presidents talking about the economy being too strong to cut interest rates right now, not needed to cut interest rates. Inflation remaining stalled out, and the labor market wage pressure starting to come down, but staying there. As you may recall, back in March of 2022, it was going up at a rate of 5.9% year over year. January of this year, 4.6% year over year. This is average hourly earnings now. 4.2% in February, 4.1% in March, and April, which we were getting at the very beginning of, on May 3rd, that's going to be announced. It's expected to be 4.0%. You also had the first estimate of first quarter GDP. You may have seen 1.6% annualized. That compares to 3.4% in the fourth quarter of 2023. But when you look beneath the surface at what they call real final demand, that strips out exports, it strips out government, and it strips out inventory changes. And there you saw real final demand, believe me, up 3.1% after the fourth quarter was 3.3% and the third quarter was 3.0%. So basically, a real final demand, no real slowdown. And these are all reasons why interest rates staying high, the Fed saying we're not going to be in a rush to cut. As of here in the early part of May, you had the GDP now number of the Federal Reserve of Atlanta for the second quarter. Now, this is an early estimate, of course. I tell you, you're going to be shocked by this. 3.9%. 3.9%. Another thing that happened during the month of April, and I would be remiss if I left this out, but you had earnings, especially of many of the big technology companies that are part of this so-called Magnificent Seven. Google, the day after they announced and the week after they announced they're going to start a dividend of 20 cents per quarter, 80 cents per year. First time for them to be paying a dividend. They announced a $70 billion stock buyback program. And revenues were quite strong. Earnings were up 62%. That stock in the third week of April was up 11.6%, up 23% year to date. That's Google, which is known as Alphabet, as you know. Microsoft, their Azure cloud, the cloud really activity of Amazon, Microsoft, or Google has been booming with all of this artificial intelligence activity as people really begin to crunch and move massive amounts of data and need more and more computing power to do so. The Azure business, the revenues were up significantly, up over 25%, close to 30%. You had 8% year to date for Microsoft, and it was a very a strong report. So that's Microsoft and it's Alphabet. NVIDIA will report not now, but later on this month. They will report on May 22nd. People will be watching that one very carefully. Meta, on the other hand, Meta announced a significant investment of $40 billion in capital outlays for the coming year. But people are wondering about how are they going to be generating revenues off of this. Meta is one of the few that does not have a cloud services business externally. Maybe they do internally, but Meta basically sold off in the wake of that announcement by 7.9%. So you're beginning to get some different movement in members of the Magnificent Seven. Meta's still up 26%, but that week that it announced that, fell 7.9%. Now, as we move into positioning for the coming month, we want to remind everyone we favor credit over equity right now. Pick up some of these generous yields and protect yourself. We would say pay attention in the private credit area to duration. That's the length of the instrument that you're considering, as well as its protection, its covenants, and its position in the capital structure. The private real estate, there also you want to be very careful as to the sector where you're lending money to, because the real estate sector has been showing itself to be very heterogeneous, not homogeneous. They moved at different levels: apartment buildings, shopping centers, retail, office buildings, of course. So they're moving at different levels, different rates. So you want to pay very close attention in the private real estate area. And finally, in the private equity area, with interest rates rising, that has put pressure on multiples. They've come down. That we see this as offering many attractive entry points. But there you want to see the valuations down, and maybe you're going to take a look at some of these partnerships that are selling. The limited partners are selling their equity, private equity interests in order to pay out their own beneficiaries, foundations, endowments, sovereign wealth funds. They are basically selling parts of their positions, and there you can pick up these secondaries at, we think, meaningfully interesting valuations. With that, we wish everyone a great month ahead. Thank you for being with us. All the best.